All right, we got another FOMC meeting behind us, and this time it comes with summary of economic projections. The big surprise is in the red box I've drawn on the screen in red. Look at the federal funds rate projection. The June projection for 2024 was down to 4.6. So by the end of the year of 2023, 5.6. By the end of 2024, 4.6, implying 4 rate cuts over 2024. Well, that is gone. Now down to 5.1, 50 basis points higher, implying 2 rate cuts over 2024. So I looked at the June Fed Fund futures to see how it was pricing in this news. This is the half year for 2024, 5.295, and it was 5.255. It increased. The implied rate increased by 4 basis points only, even though the SEP is suggesting that the Fed is more resolved to saying, look, everything is good. Economic growth is strong. What do we need to lower rates for? And when we get to the press conference, we'll see there was a couple of questions about, do you think the neutral rate is higher, Jerome? Anyways, look at this change in real GDP from the June projection, all increased from 1% 2023 up to 2.1. 2024 from 1.1 up to 1.5, and then hitting trend in 2025, 2026, and of course that is their trend growth of real GDP. So above trend this year, below trend, and then hitting trend. The unemployment rate for this year, 4.1 in June, let's say 3.8 now. 4.5 for the end of 2024, down to 4.1. Again here, 4.1, hitting the longer term of 4. And core PCE, 3.9. June projection was 3.9. They're saying, no, it'll be a little bit lower. It'll go down to 3.7. And this is where I find this inconsistent. You have 2023 saying, okay, we're going to come in lower than we thought. Growth is going to be stronger. Unemployment won't be as high as we thought, but inflation will still come down. So they were looking at 1% with 4.1% unemployment, saying inflation will be 3.9. Now they're saying, no, growth will be double what we thought. Unemployment won't be that high, but core inflation will come down. However, we're not going to, we're actually raising the length of time at which we'll keep rates high. I see a little bit of inconsistency there, so I do point it out. Lower forecast for 2023 on top of higher growth and lower unemployment. So I think the questions about the real rate being higher are legitimate questions. Are you seeing, given what we're seeing here, are you saying, implicitly saying, hey, listen, we seem to be getting the job done. We have full employment, and inflation is coming down. In fact, we're projecting it to come down a little bit quicker this year. And we've done 500 basis points of rate hikes, and this is kind of magical. So maybe it is higher. Look what's going on here. Central tendency for the Fed funds. This is the September projection. This was the June 5.4 to 5.6, 5.4 to 5.6 for 2023. But look what happens in 2024. 4.4 to 5.1 is now 4.6 to 5.4. Higher into 2024. And look at the range. This I find curious here as well. 5.1 to 6.1, and now they have better clarity on what they want to do. 5.4 to 5.6, so a little bit higher and a little bit lower in the middle. But look at this one. 3.6 to 5.9 is now 4.4 to 6.1. 6.1 going up to 6.1. From where we are here is 5.6, dropping to 5.1, dropping to 3.9. But somebody in 2024 is at 6.1, but they're not at 6.1 because this is the range. It would be the high and the low, right? That if somebody is 6.1, they would be over here. 6.1. I find that one rather interesting as well. I think the big takeaway here is this one right here, is the cut for 2024. Implying that there would be 4 rate cuts, now implying that there would be 2 rate cuts. Let's have a look at the summary of economic, the dot plot in the summary of economic projections, because there is a question about this. All right, let's look at 2023. There are 19 dots everywhere you go. Notice as you go to 2024, 2025, 2026, notice how it widens, and then over the long term, everyone kind of coalesces in a tighter range. But look at all the uncertainty in here. Not a lot of uncertainty here, but I find this rather interesting. There's the 5.5, the dotted line here. You have 12 of the 19 dots that are above 5.5, suggesting 12 of the 19, and this is for 2023. We have 2 more Fed meetings. 12 of the 19 are dotting 1 rate increase. 7 of the 19 are saying no rate cuts, but no rate hikes, but 12 of the 19 got rate hikes. Now, he was asked a question about this, asked to characterize the debate that went on around that, and his answer was, look, everyone just put their dots down. I mean, that's all we did. No, there was no debate about it. Okay, let's get to the Q&A. Some good questions this time, with answers that a couple of the answers were cryptic, but and especially his last answer I thought was rather interesting. We'll see when we get to it here. Financial Times. Oh, by the way, I tried to get this video up as quickly as I could. If there are any spelling mistakes on the screen from my typing, we'll just correct them as we get to them. I'm not going to stop, correct it, and then redo another screen so it makes it seem like I have perfect typing, because I don't. Financial Times. Why does the committee not think that rates are sufficiently restrictive at these levels? By the way, if you are a viewer of the press conference over time, Financial Times always leads off. I don't know what they paid to get the first question, but they always have the first question. Why do you think rates are not sufficiently restrictive at these levels? And the answer is, we need to see more progress before we're willing to declare we are at our level. And a good follow-up to that is then why the shallow path of rates in 2024, 50 basis points higher than June? In June, you had 5.6 going down to 4.6. Now you're only going down to 5.1. What gives? Answer, real rates are meaningfully positive, but economic activity is stronger than expected. So his answer here is that, look, if you're looking at your question here about being sufficiently restrictive, yeah, okay, real rates are there. But listen, this is surprising everybody, economic activity. So that is why we figure, hey, listen, we're at 5.5 and economic activity is more than double for Q3. The Atlanta GDP now is more than double the trend growth rate, and we're at 5.5. What do we need to cut for 100 basis points next year? So that's sort of what he was saying, is like, come on. Washington Post characterized the debate about another rate hike, and that was about the dot plot, 12 of the 19 seeing one more rate hike before the end of the year. And he said, he noted, 7 of the 19 in the SEP, no hike. This is not September. This is the summary of economic projections. Everywhere you see SEP, I am not referring to the month. So 7 out of 19 say no hike. 12 out of 19, one more hike by the end of the year. No debate. They're just SEP inputs. Everybody is waiting to see more data. So he's just saying 12 people put down one rate hike by the end of the year. We didn't debate it. That's all it was. Follow-up, what would one more rate hike do to the economy? And he says this a number of times. Like, this is his new words here. Rather than say, we're pausing or whatever, we are in a position to move carefully. And he's repeated that in the press conference a number of times in a number of places. And I think that's the new messaging from the Fed, is that, hey, we're not saying we're going higher, we're not saying we're going lower. We're in a position to move carefully. I would not attribute much impact to one rate hike in macroeconomic terms. Next up, Steve Leisman, CNBC. Why have the same inflation projection? Remember, I pointed that out when we looked at the summary of economic projections. In fact, for 2023, they actually had a lower inflation projection with the same projection for 2024, 2025, and 2026. He says, why have the same inflation projection, but need another 50 basis points of rates in 2024 than projected in June. Question mark. Look at the teacher in me coming out. And with such a long view of higher rates, are we to expect that the neutral rate is actually higher? And I said, good work, good work, good work. I'll give you an A- on that one for that question. It's a good question. Higher 2024 rates than June, more about stronger economic activity. Neutral rate, we know it by its works. Those are his words. We know it by its works. We only know it when we see it. It may be that the neutral rate has risen. He was asked that again. He gave the same answer. He says, as far as neutral rates and being restrictive on neutral rates, we will know it when we see it. And that was it. Reuters, below trend growth. Seems to be less below trend in the SEP, but inflation projections are basically the same. Does this mean that the cost of reducing inflation in terms of an economic slowdown or a recession, does this mean the cost of reducing inflation is lower? Yes, of course. But still feel there will need to be some softening in the labor market. We have been seeing progress without higher unemployment. He mentioned that 2 or 3 times, that we are seeing some progress in the labor market without unemployment having to increase because of an increase in supply and a reduction in demand. Follow-up. Would you call the soft landing, and I'm just going to refer to that as SL from now on because I don't want to type it out. Would you call the soft landing a baseline scenario? No. No. He said no twice. No, I would not do that. Which is interesting because later on he does refer to the soft landing as their goal. No, I would not do that. Always thought soft landing was a plausible outcome. I do think it is possible. We will restore price stability. We are in a position to move carefully. We don't want to handicap the likelihood of a soft landing. So that seemed like a reasonable answer. He's saying, look, don't ask me to give any kind of probability on any kind of outcome. We have a mandate. We want to reduce inflation. We're going to get it done. Thank you very much. But later on, he says something that sort of counters this. Wall Street Journal. You and Williams note real rates. William is the head of the New York Fed. And he had said that rate cuts would likely be necessary in 2024 as inflation comes down. Nominal rate cuts would be needed to keep real rates from getting too restrictive. So what happens is we know that nominal equals real minus inflation. So as inflation comes down, if you don't lower the nominal rate, the real rate implicitly rises and becomes more restrictive. Williams is saying we would have to lower the nominal rate if we're targeting a real rate of, let's say, 3%. As inflation comes down, we'd have to lower the nominal rate so that the real rate doesn't get too restrictive. So Wall Street Journal, Nick Timmeros is saying, you and Williams note that real rates are noting real rates. Is FOMC targeting a real rate of policy restriction? Can nominal rates reduce while keeping real rates restrictive? Answer, yes. This is to the first part. Yes, it's a real rate that will matter. We know sufficiently restrictive only when we see it. There it is again. We do see inflation coming down. Confidence comes from seeing enough data to stay at a particular level. The task is finding that level now. We are not at a point of confidence at this time. So he's not saying, hey, this is it. We're at this level. He's saying we need to have confidence first. We're finding that level. We just don't have the confidence that this is the level yet. New York Times, sort of a follow-up from Wall Street Journal. Question references Williams again, lowering nominal rates as inflation drops. We know that Williams has already spoken on that. Is that what you're thinking as well? Do you see rate cuts in the first half of 2024? And he answered this one first. I didn't think he'd answer that one. Any answer about cuts are purely hypothetical. Because in the question, it was referenced in a previous press conference, you said that something is about a year off. Or earlier in the year, you said something is a year off before you start thinking about something. Given where we are now, do you see rate cuts in the first half of 24? And he said, hey, if I ever said anything about rate cuts, okay, purely hypothetical, you can't hold me to that. The time will come at some point, and I'm not saying when, that it is appropriate to cut. And he's saying the time will come at some point, and I'm not saying when, that it will be appropriate to cut. Axios, strong economic activity. Is that demand or better supply? In other words, he's saying, is that coming from the demand side or the supply side? If GDP keeps coming in hot, would that be a reason to keep hiking? And he said the consumer is driving GDP. GDP is not our mandate. In answer to the second one, if GDP is coming in hot. So the answer to the first question, strong economic activity, lower demand or better supply. And he's saying, well, it's consumption really that's driving GDP. So it's not lower demand, it's just higher demand. And whether it's the same limited supply or increased supply remains unanswered. But on the second part, GDP is not our mandate. The question will be inflation. Would hot GDP drive inflation? And if it does, then we will act. But GDP is not our mandate. Full employment is their mandate, is the other part of their mandate. And full employment could be seen as keeping the economy at trend growth. So in essence, buy a transitive property in there, GDP, to me, seems like it is part of the mandate. Politico, rising oil prices, strikes, government shutdown. How are you thinking about these? Yeah, you know, I've been out of the country for a while. I totally forgot about this thing coming up September 30th. I better put a T on there before you think I'm saying Summary of Economic Projections 30. September 30th. So we're going to have to start talking about that and the drama around all of that, right? Rising oil prices, strikes, and I don't know if you heard this morning, a plant that supplies Mercedes, their staff went on strike as well. And labor just seems to be reinvigorated these days. And I don't blame them really, because the share of, I've shared this before in one of the market outlooks, the share of labor or the share of income going to labor has been decreasing. I think the last 2 decades, and the share of GDP going to capital has been increasing. Profit margins are at record highs. It was going to be some point at which labor was going to say, listen, we simply can't keep up with this. Answer. I said, how do you think about these? He's saying, yeah, lots of things to look at. So much uncertainty. He wouldn't comment on the strike, about anything about the strike. He did comment about the effect on the economy. It could affect the economy. This is but no idea how much, how long, etc. In other words, I don't know. This stuff is hard to forecast, and he's right. It's hard to forecast. It could end tomorrow. It could drag on for weeks or months. It could get worse. It could get better. Energy may be significant, but he says it would be a sustained period that he would be concerned about. He says energy and food do this kind of stuff all the time, right? Over short periods of time. So they can cycle like this over short periods of time, but it is high prices sustained for a while. That is where the problem happens. So they're looking for a sustained period that could affect inflation. Bloomberg News. Not Michael McKee, somebody else. Surprised that soft landing is not the objective. Jay, don't you risk losing the economic strength we have now? And he answered, he goes, whoa, the soft landing is a primary objective, and I did not say otherwise. But earlier, he wouldn't characterize the soft landing as the base case. No, I would not do that. It's plausible. It's possible. And over here he's saying, whoa, hey, back off, buddy boy. It is a primary objective, not an objective, a primary objective, and I did not say otherwise. And I think, you kind of did. The worst thing we can do is fail to restore price stability. So, I mean, I guess, okay. So you're giving a nod to it, saying, hey, no, we think it's important, but listen, this over here. We have the ability to move carefully. There it is again. Associated Press. We've seen disinflation so far. Is this the easy stuff? He called it the low-hanging fruit. Is this the easy stuff, or is this the hard work of interest rate hikes being done? Answer, we knew bringing inflation back down was going to require, one, unwinding previous year stimulus. I saw the question mark. Where am I going with this? was going to require, one, unwinding previous year's stimulus, and two, bringing supply and demand into balance. That is what we're seeing. We're seeing this, and we're seeing this. So I don't know if he's saying, yeah, that's the easy stuff or the hard work being done, but he's just pointing to this is what we're seeing. Bloomberg TV, this is Mike McKee. Just a blatant, straightforward question. How much confidence can anyone have in your forecasts? In a nice sort of way, he said, looking back at the other SEPs and looking at this one, you're all over the place. And he is. If you look at the SEP, I shouldn't say he, they all are. And here's the big takeaway from this. It is brutally difficult to forecast. The forecast really is just your best guess. We seem to think that these people in that room have this information that nobody else has, that they have this look into a crystal ball that they themselves have, and that their forecasts are to be listened to and respected, and oh, these are the best forecasts out there. But if you look at all of their previous forecasts and what happened after that, no, they're all over the place. They don't know anything more than you. They have more education in certain disciplines, and with that education they make their informed guess, and their guess may be more informed by certain models and certain training than yours would be, but that does not mean that it's better than yours. So his answer is forecasting is difficult. And I like this line that he threw in there. Forecasters are a humble lot with much to be humble about. So I think that he probably was prepared for that, saying, oy, we're changing the SEPs again. Like, we're all over the place. Somebody's going to call me out on this. So he had to come up with a good quote, probably went on to quotes.com and said something about forecasting. Here it is. Forecasters are a humble lot with much to be humble about. Now, I didn't Google it, so I don't know who to attribute it to, but after I'm done this, I am going to Google it and see if somebody said it somewhere. He'll probably say Jerome Powell, September 2023. Growth has come in higher than anticipated. More progress in labor market without higher unemployment. He said this is the surprising thing. Growth came in much higher than anybody anticipated. And we're getting more progress in the labor market without higher unemployment, which nobody really anticipated. And we're getting progress in core inflation. Economic forecasting is difficult. These are highly uncertain forecasts, but these are our forecasts. Follow up. Why not move today? If 12 of the 19 saw a rate hike by the end of the year, why not move today? We have the ability to move more slowly, more carefully. I said it in a number of different variants, but that was if the press conference was a poem, this is the rhyming couplet that you see throughout. Yahoo Finance, would base effects not give you a low November PCE? Second question, if a government shutdown, what about the lack of economic data? And when I thought about that, I go, yeah, that's a good point. What if the government does shut down on the 30th? You're not going to get the September jobs report. And depending on how long it's down for, you're not going to get September CPI in October. And no comment about shutdowns. He's not going to wade in on the political side one bit. Possible we may not get some data. We would just have to deal with that. All right, we're almost near the end here. Fox Business. How does rising energy factor into your thinking? I don't think he heard the previous question when he talked about it. How long can the consumer manage this with rising credit card balances? That was his follow-on question, but I just folded it into one question. Answer comes down to how persistent it ends up being, and that is about energy, which he had answered before. And as far as credit card balances go, I find that a very misleading statistic, by the way, to say, oh, credit card balances have never been higher. Yeah, the money supply has never been higher. Wages have never been higher. So if you think about your debt level, your personal debt level as a function of your disposable income, if your disposable income is going up and your debt level is going up in proportion, that your debt level, let's say it's 40%. Let's say it was 40% of everybody's disposable income, and disposable incomes are going up. Well, duh. So would debt levels. So would credit card balances. So just because credit card balances are are the highest now, you would naturally expect them to be higher than 40 years ago. Number one, more people have credit cards. Number one. Number two, people have higher incomes now than they had even 3 years ago. Just the nominal increases you've had over the last 3 years. So I find that to be a very misleading, indicator. So what you want to look at, and he answered it, I think, in the best way, is not so much the level, but some kind of ratio. Measures of consumer stress are moving back up to normal levels, not at troubling levels. So I've given this example before. Let's say that we see a company with $50 million in debt. 5 years later, they got $500 million in debt. 5 years later, they got $5 billion in debt. Would you say, oh my God, this company has a debt problem? But what if they had $100 million in equity at this point in time? And then they had $3 billion in equity at this point in time, and now they have $50 billion in equity at this point in time. This debt is more than manageable. This debt is far more manageable than this debt. So looking at the level of debt doesn't make a lot of sense. You have to look at it in terms of its ratio against something else. And when we look at consumers, looking at default rates or looking at delinquency rates is a far better indicator than saying, oh my God, credit card debt is over $1 trillion. Yeah, but GDP has never been higher. Wages have never been higher. So yeah, so I don't like looking at levels when it comes to something like that. M&I market news: yields along the curve have risen, and I just say, he gave blah 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 blah. What do you think? I just say, what gives? Answer: growth, real yields, term premiums, supply of treasuries. There's a whole bunch of reasons why, and he's saying it's not really because of inflation. And I guess he's got a point. The last 3 months you've seen inflation tick down. But let's be careful there. Canada reported their CPI. It ticked back up. So it looks like it wants to go back up. And really, how can you have very strong economic growth, a very strong labor market, and we know that consumers spend, and not have inflation moving back up? It just seems rather curious. So yeah, he said, if you disaggregate it, and he said there's lots of models out there that disaggregate where all the premiums are coming from. It could be growth, it could be real yields, could be term premium, could be all the supplies, but he brushed it away and said it's not because of inflation. American Banker: this is an interesting question, actually. How does taming inflation hinge on housing supply? And we know that there is a structural shortage of housing. Even worse in Canada, even worse. In Canada, the latest numbers I saw is that we have five people coming into the country for every new rental unit put on the market. 5 people in, 1 rental unit. And our government thinks there's no reason to slow down immigration. In fact, let's speed it up. And let's bring them in to a country in which they cannot afford housing. In fact, along with that report came a surprising statistic that new immigrants to our country in the last year have been the fastest group to fall into poverty. Now, why would you do that, right? Anyways, I'm going off on a tangent here. How does taming inflation hinge on housing supply? And this is an interesting one. Given the lock-in effect you're seeing now, the lock-in effect meaning you had rates really low, you had like 3% mortgages that are locked in for 30 years. And that lock-in effect is keeping supply low, right? Given the lock-in effect you are seeing now, would that stop you from hitting the lower bound in rates again? And at first I thought, I don't quite understand where you're going with that. But this is what he was getting at, saying, listen, when you brought rates down to zero, you created a whole bunch of 30-year mortgages with super low rates. Now that you've raised rates, you've locked them in and you've taken that supply off the market, thus actually inducing inflation in the housing market. Your interest rate increases are actually working against you in the housing market. Being that you can see this now, would that ever stop you from going to the zero bound again? Because you would do the same thing all over, as you would would flood the market with all these cheap mortgages, and when you had to raise rates, these people are unaffected by your rate increases, and you've locked them in, meaning that supply is going to come right off the market, keeping house prices elevated. I thought, okay, that's a good question. His answer here, supply is structurally constrained. At least he didn't say, oh, we don't see an issue with supply. At least he said, okay, yeah, you're right on the supply issue. Rents are now being reset at lower increases than last year. As for the lock-in effect, that would not stop us from doing what we need to do at any time. He's not even going to give it any thought. Marketplace. Would the Fed welcome a decrease in consumer spending? I wouldn't say it that way, the way he said it, because he's got to be a little bit political there, right? I wouldn't say it that way. If the economy comes in stronger than expected, that just means we would have to do more. Okay, The Economist. There seems to be a lesser level of interest rate sensitivity, and it seems to be bifurcated. How much so? He said you have a lot of people who are immune from interest rate hikes, and then you have a bunch of people who feel nothing but the interest rate hikes. Do you have any idea about the distribution of that? And as far as lesser interest rate sensitivity, he answers that the economy is stronger than many expected. Balance sheets are strong. Maybe the neutral rate is higher. And then he offered several reasons interest rates have not had the expected effect on growth. So he's saying it's not that they're less interest rate sensitive. It just may be that they're less interest rate sensitive at these levels, that we haven't hit the sensitivity yet, that if we go a little bit higher, we might find the sensitivity there. Which is the same as saying, aren't they a little less interest rate sensitive? And as far as it seems to be bifurcated, how much so, the people at the bottom who really feel it. He said, the reason we are focused on restoring price stability is precisely for those less capable of handling it. And I thought, oh, nice answer. The next one, I wasn't even going to include because it just sounded like some social, blah, blah, blah. Talking about the last beige book, he said you had some surveys of nonprofits and community groups about the effects on low-income people. Are you going to be doing this anymore? Is there anything there you want to comment on? Anything there that you see? Anything that can change policy? And his answer, he gives a beginning part of the answer. Then he states what I think is a very Republican answer, and then he, gives another part of the answer. But the middle part of it basically said, what about these low-income people? He said, hey, the job market is strong. You got real wage gains, okay? What more do you want us to do? If their incomes are low, it's not like they can't get a job, and it's not like there aren't job gains. At least that's the way I read it. Why put that in there? Job market's strong with real wage gains. There it is right there. You want opportunity? There's opportunity. Thank you. Anyways, that's the press conference. Before we go, Can we say something about Powell's iPad? It's an old model. Look at that camera. That's about 4 or 5 years old. Can we not, for the head of the Fed, can we not spend $1,200 and get him a better iPad? Should he not have a better iPad? This is like, it might even be his own iPad. It might even be his personal iPad. Anyways, I just thought I'd point that. I saw the iPad. I go, you got to be kidding me! Like, couldn't they provide him with something? He's the head. He's the chair of the Fed, for God's sake, and he's in the press conference. The cameras on him. Dress him up a bit. Give him a fitted shirt. Give him a custom-made suit. And come on, man, give him a better iPad. I've got better iPads. And I'm not the head of the Fed. Although I will say I do make more money than him, so maybe that's why I got better iPads. Anyways, there you go. There is the Fed meeting.